Good morning, everybody. I would just also say happy third anniversary to Investors Inspiration. It's a pleasure to be with you all today. I'm going to talk to you today about trade consistency because, when we talk to our big trends community about what is on your mind as far as what you want to accomplish in your trading as you look ahead past the election, I'm going to give you a few stats about what's coming up here with the election and with the time of year. It's a really good time of year to be in the stock market as we speak right now, looking forward. But bottom line is I want to focus you on, okay, how can you really, increase that win rate, increase that, when you put on a trade that your expectancy to win is very high. We're talking about preferably somewhere in the neighborhood of about 80% of the time, give or take, maybe a little more or a little less. And what I'm going to show you today is I'm running actually more than that here this year, and so we're going to walk you through that, and then of course talk about how you can position yourself for that kind of consistency into 2017 and beyond. Just a quick reminder that everything that I'm sharing with you today is for your information and education only. We will look at the current markets, but nothing that I talk about here should be considered a specific recommendation of buy or sell any particular security. Ultimately, you know that you are solely responsible for your own investment decisions. Here at Big Trends, my team and I are not responsible for any trades you choose to make. And not all Big Trends products or services are appropriate for all types of investors. What we do at Big Trends, we don't provide anything personalized in terms of financial, tax, or legal advice. So we send our alerts out when we see a new buy or sell signal to all of our subscribers in that service at the same time, real time, via real-time email and now real-time text alerts. So you can then decide how you want to use it, and then consult your tax advisor too before you make any investment that's going to impact your tax situation. Okay, so with that in mind, we want to talk about this kind of consistency and how do you get that kind of consistency up. And the other thing that everybody's telling me they want is more income. Who doesn't, right? But more regular income, kind of like how do you create that extra paycheck, if you will, that kind of consistent thing that keeps paying you, so you let your money work as hard for you as because we all know you've worked hard for your money, so you want to get that money working harder for you, especially in a zero interest rate environment. Yes, the Fed's likely to raise rates in December, but I think that's going to be a token raise. We've said all along this year that they weren't going to raise before the election, of course, but that they would likely raise after one time and then probably be done. So rates are, in my view, probably going to stay near 0% in your bank account, and the reality is you need to figure out another strategy to start creating income. So we're going to talk today about how my system on the S&P 500 is really where we want to focus, define support and resistance. That focus is so important. We've got a lot of great speakers today. We're going to talk about a lot of different things. I would rather see you decide, kind of what's the one area of focus that you can really leverage yourself for starters, because you try to do too many things at once, nothing's probably going to stick. I want to see you kind of say, listen to everybody, focus on what really makes sense to you, and then figure out how you can really apply that consistently. Then you can add additional techniques over time here, okay? So basically from this perspective, we'll talk about technical analysis as well and how our system is basically quantified, tested over decades of data in the S&P. We've got tons of data there, of course, and how we want to create this consistent cash flow, regardless of whether it's volatile or non-volatile. As Vince mentioned in the prior talk, basically it's been a very, very sideways, choppy phase in front of the election, and the question is what happens after the election. We're going to talk about that and what's coming up, I think, over the next 6 months. Now, just a reminder here, what we've done thus far this year in this particular portfolio, just on the S&P 500 ETF, which is called the SPY, or the SPIDER, some people call it. Just a reminder that past performance doesn't guarantee future results, of course. These are examples of the gross profits we generated over the course of the last roughly 7 months. Since we basically just tweaked the strategy, we actually started shutting down these trades before expiration when we can get the majority of our profits. And when we started doing that, we noticed our consistency went up even more. So it's already a nice consistent strategy. We just basically enhanced it to be that much more effective. And you see the 7-month return, gross profit of 32.6%, the S&P up over this period about 5.1%. Now, you say, okay, so that's beat the market by about 6.5 times. And that, again, that's before commissions. You need to factor your commissions accordingly. But the beauty of this strategy is it's not hyperactive. You can actually see the entries here where we got in on the left are basically about one a week on average. Sometimes it could be a couple couple in a week. You see we had a couple there mid-September. Sometimes we wait a little bit. We actually didn't have one this past week because we didn't see the right setup. So a big part of what our Big Trend subscribers appreciate is that at Big Trends we trade for results, not activity. We're not interested in just throwing trades out and hoping something sticks. We only trade if you've got a meaningful trading edge. Now, the way to read this, and we're going to come back and look at it a little more later, and as you start to understand what this strategy of called credit spreads is all about, call and put credit spreads, it's different than what you normally think of when you talk about an option call or an option put. So, but we'll get to that in a minute. But what we're saying here is that if we collect in 0.20 means $20 a contract. It's every contract controls 100 shares, so that 20 cents times 100 is $20 a contract we're collecting. And on this particular model portfolio, we said never risk more than $1,000 in a trade, because even if the worst case happens and you did have a loss on that trade, you're not going to lose your whole portfolio in any one trade. In fact, you're going to keep your risk very, very manageable. But we believe that taking a big loss is not advisable. So on this particular window of trades over the last 3 months, you can see that we had one losing trade, we had 13 winning trades. Now I tell people that's more than 90% win rate. I don't tell you to expect that. I tell you to expect actually more like 8 out of 10 trades being winners and a couple of losers out of every 10 with this strategy. It's going to happen that you're going to occasionally have losses, but you can see with this approach it's been highly consistent, and the bulk of our growth over the last 7 months has really especially accelerated here in the past 3 months. So while everybody else is saying it's not a very tradable market, we're sitting here saying yes, it's indeed very tradable. So we're going to come back and look at that strategy. But I want to give you a couple of quick thoughts here as we look forward. It's easy to get stuck looking backwards at the past and trying to project that in the future. And there's actually a big mistake that a lot of traders make, because there's two very different 6 months patterns that we have going all the way back. When you look at the data since 1950, we basically would say, if we're looking at the November to April phase, we're just about to enter here, this is where the market makes most of its gains. On average, the S&P was up 7.1% over that 6 month window, compared to the May-October window on the right, where it was only up 1.4%. So that means that more than 80% of the market's total gains in the S&P were driven out of the coming 6 months. It's about to start this coming Tuesday. Less than 20% of the gains happened for the period that's just now ending. I think a lot of the reasons this happens as drivers is, of course, you get a lot of the earnings that really start to pour in around Christmas time and into the beginning part of the year. But really, I think the biggest driver is this right here. The 401k retirement money piles in near the end of the year and also right before tax time, because everybody realizes, I need to get those contributions in before that tax year effect is over. Versus when you look at why is the market usually weak in the summer, there's a lull, of course, because things kind of slow down. People are taking time off. Things aren't as busy economically. And then you say also, what the big driver to me is the mutual fund tax years. A lot of them end at the end of October, and that means you get tax loss selling that happens often in September and October, and then those stocks get rebought into November and December. So that's why if you look at the month-to-month performance for the market, like we're talking about here, we're just now ending this period May through October. Notice anything about that May to October period? That you notice 4 out of those 6 months are negative. In fact, if it wasn't for July, it looks like that the overall 6 month period would be negative. This is going according to Jeff Hirsch's Stock Traders Almanac, which is a great resource. I pick one of those up at the beginning of every year for the new year, because you really get a lot of good history and seasonality of the market. Now, if you look at where we're about to start, actually we're into a really nice seasonal phase even here as we head into November, December, and then January, the best 3 month stretch of the year. And then you go on out to February, March, April. Notice anything about 5 of those 6 months are averaging more than a 1% gain. This is on the Dow Industrials, but same concept, that 5 of the 6 months coming up, November through April, the only month being not averaging a 1% or more gain over 65, 66 years is February, which is barely positive, you can see. So 5 of the 6 very positive, 1 of the 6 flat. So you look at that and you say, okay, gee, if you're getting stuck sitting here saying how terrible the market is, or how after the election the market's going to tank, I think you're making a big bet against history. I don't bet against history, I bet with history. And so everything I'm going to show you here is about the data testing that we do. Other little nice note here, I've found this nice little thing on the web here going back to 1897. Didn't have an update over the past 4 years, but basically going back over the 4 election years. When you talk about we're in an election year. So, if you look at where we are right now, we're somewhere in this neighborhood of about here in this election year. You look at that and you say, you know what, that's a pretty good seasonal pattern there into basically not just through April, but it looks like through up to about July earnings season next year, that the seasonal history would really favor a bullish run for the market. In fact, you see the average gain from the benchmark there would take you from about 103 to over 110. That would put you in a position to make up something like a 7% gain as well. So you know what, that also fits with, if the market's 7% higher from these levels, we're going to be pushing towards the Dow from 18,000 and change to probably pushing towards Dow 20,000 at some point by the middle of next year would be my assessment based on history. Again, there's going to be bumps in the road, there's going to be fits and starts, but that the bias looks very favorable to the middle next year. After the middle next year, you see in a post-election year into the following year, things really flatten out again. Why? Because this is where a lot of times the Fed is taking the pain to basically then try to open the spigots up as you get past the midterm elections. That's where we usually get another big lift to the upside and things take off into the pre-election year. Okay, so that's we're talking about multiple years out here, but it's useful to keep these seasonal patterns in mind. Now, what I want to share with you is take that big picture and then narrow your focus right back down here. Okay, so basically just in this perspective here, you're saying, yeah, that you're really looking at a situation in which and this is an election year, Eric. Yeah, so we're focusing on election and forward there, but basically, what we're looking at here is that we're going to find a system that actually shows you where the market is overbought or oversold, where it's kind of hit a likely stopping point on the upside, which is, we're going to look at these upper and lower blue bands here today. This is the Donchian channel approach, and I've tested just a load of different systems over the years. When I launched Big Trends back in '99, I did it on the heels of my indicator acceleration bands, which helped me catch a lot of the big booms in the tech stocks and the brokerage stocks and a lot of the others in the mid to late 90s, which built my capital up to where I said, okay, I've got enough capital, I can go do this myself and run a business and teach people how to trade as well as trade myself. So it's kind of one of those where, just showing people how I've done that successfully and how you can do that successfully yourself. The interesting thing is, of course, the market environment is a lot different than it was in the late 90s, right? But the beauty of this is that we'll take whatever edge we've got to take advantage of here. Now, you notice we're going to look to buy usually around the lower end of these Donchian channels, but we've got to get some other filters that kind of hit at the same time to catch these turning points. And up at the upper end, you're going to see we're going to catch some potential peaks here. We're going to be able to benefit, and sometimes even on our short-term system, it doesn't have to touch the upper band, and we can see it roll back over. I'm going to show you an updated version of that here in a minute, but what I want to show you is when we went back and tested 20 years of history, okay, so 2 decades. You're saying, okay, there's a lot of different things that have happened over the last 20 years. I know you would agree. You've had the big bull markets. You've had the Great Recession of 2008. You've had of course, in the last 20 years, you've had the collapse of the tech bubble in the early 2000s as well. So, the booms and busts are all in there. Then you look at this and you say, okay, of all the trades, you see it was $40,000 plus, but interestingly, of course, the long or bullish trades make up in the neighborhood of about 65% of those gains, 28,000 of those gains. These examples, again, before commission, so you'd factor your commission rate accordingly. What I thought was impressive, though, is even with the general bullish bias of the market, the short trades have still made healthy profits as well here, 12,799 on that particular data test. The other thing I wanted to point out to you is your percent profitable. This is if you're just buying and selling the SPY itself before we get into then adding the option strategy component onto it, is 61% win rate. Now, and you look, what's interesting is that look at how close they are, 60.95 on the total, 61 on the longs, and 60.87 on the shorts. That's some pretty consistent. You don't see that a lot where it's that kind of consistent on both sides, that they're within fractions of a percentage point of each other. So that made me encouraged when I was testing this data. Now, when I went and looked at the history of the equity curve, over the last 20 years, you had almost 1,000 signals, about 950 signals. So you break that down and you say, okay, well, that's putting in the neighborhood of about a signal a week. It's about almost 50 trades a year, and that's about a trade a week on average. Now, what you see is all the green dots here. Again, past performance doesn't guarantee future results, but I like those green dots because those green dots mean new equity highs in your portfolio. I think that we're all after that, aren't we? You want to be making higher and higher highs in your portfolio, and you want to also see that when you have a give back phase, like in this example, you can see that it has a choppy phase. That some of these choppy phases, when it's basically not going anywhere you're buying, you're selling, you feel like you make a little, you lose a little, you make a little, you lose a little. Just trading the SPY, then at least it's not giving back much. But even better, when I saw that, I said, you know what? When I see that we don't have a lot of give back phases here, not in a sharp way. Occasionally, sure, you're going to get dinged. You see there's a couple where you're just on the wrong side. That's going to happen. This is why you don't put all your capital in any one trade and any one trading system, because you're going to get dinged every once in a while. But overall, in a sideways period, I can set that up for profit too with options. One of the reasons that I was attracted to options, going all the way back to when I just started trading when I was at Duke University, and when I graduated from there, I said, I love this options game because you can do so many different things with options. Any strategy you want, you can put the odds in your favor, because if you take the 61% buy and sell of the SPY and we flip it, actually 62% on other data tests, so basically say you're right in that neighborhood, the low 60% range, you're saying that's good. That's actually, you can do real well with that. So what if we flip it and actually say, instead of buying the SPY, what if we start selling options premium against it? And what we were after was actually, you can see that on this chart on the right, this is your classic standard deviation. One deviation covers about 68% of the outcomes. You're probably familiar with Bollinger Bands. 2 deviation Bollinger Bands are often used, and those are supposed to cover about 95% of the action. You can see that 3 deviations should cover most all the action, but about 0.3% of it. So the area under the curve is what we're trying to increase our odds of covering that expected range, and at the same time get enough premium to make that pay off. So if you go too far out in your deviations, you're going to actually not get enough premium, and after commissions you'll have nothing left. So you have to still have some market timing. In this case, we don't really want you to focus on too many different symbols with getting started with this. We'd rather say, let's just focus on the SPY, because that's the most liquid active vehicle out there. So in this example, though, let's just start with a couple of overviews of kind of the way you could set these up. This is my favorite income strategy of all, short-term credit spreads, because you're collecting money into your account. The beauty of this is you can be bullish, but you can actually be paid even if you're flat or even if it's a little bit against you. So bullish, neutral, or slightly against all pay off on this strategy. So you increase your range of profitable outcomes dramatically versus a normal thought that if you're bullish with options, most people think, okay, so I'll buy a call. You've got to get an up move if you buy a call. In this case, we're going to flip it. So what we're going to do is we're saying, look, the stock's at 47. Instead of buying a call where the stock has to go up, we're going to sell a 45 put. This is called an out-of-the-money put. When you sell an out-of-the-money put, that means that you have 2 points of wiggle room for 47 down to 45 at the expiration. Anything at 45 or higher at the expiration, and these options go off the board at no value, you pocket that net premium you collect. But notice, I'm not just going to sell that put by itself. That would be called a naked put. I don't want to be naked. I don't want my subscribers to be exposed to that kind of risk. That if the stock totally tanks, you're on the hook at $45. If it crashes, you've got problems. So what we do at the same time is we also buy another put further below to protect ourselves as the insurance piece of this spread. Now, you're still collecting net money in. It's not collecting as much money if you just sold the option by itself, but it's also reducing your risk, and more importantly, it's reducing the amount of money that your broker is going to require you to hold as what's called margin. This is called a margin requirement to say, look, you know what? If you do this trade, you sell a 45 put, you buy a 40 put, you collect $200 on that trade. You could lose $500 on a contract. So if you could lose 500, but you collected 200, your max net risk here is $300 of risk. If it crashes to 40 or less, you can see that's where your worst case scenario happens at below 40. You're saying, okay, now I've got a worst case risk scenario because it tanked, right? It was at 47. If it goes below 40, you were not just wrong, you were badly wrong. What you want with this strategy is the stock to not move dramatically against you, okay? So instead of having to have it move dramatically for you, which is what you need if you buy options, you are now saying, look, I just want it to not move dramatically against me. So that's why that timing system becomes so important. I'll go into that more. But you can see here, what I love about this strategy is you don't have to be perfect. In fact, you don't even have to be near perfect. You can be right about it going up from from 47 higher, you can basically see it stay flat here at 45. You can even see it go down a little bit here, down from 47 to 45. Think about that. That's wrong by about 4.5%, and you still get paid your maximum $200 gain on this example. Okay, so where do you start to see problems? Below 45, you start to get back your profits. You're still profitable though. Down, these are at expiration numbers. At expiration of $43 in this example, you would break even before commissions. So factor your commissions according to how much you have to pay. If you're paying too much for commissions, you really need to look at getting your commissions down, because this is definitely any strategy. You want to keep your cost of commission down, but this is important in this any kind of spread strategy here to get your commission rate as reasonable as possible. Now, from this perspective, you see at $43, the stock was at 47. Hold on. I could be wrong by almost 10% on the stock and still break even at expiration at $43. That's giving you a lot of wiggle room, a lot of comfort. You can see that below 43, it starts to go against you, and like I said, 40 and less is your worst case. We want to shut it down, obviously, before it gets that far down. So, that's why we use a SPY, because your risk of big gaps with a SPY is much less than your risk of a gap with an individual stock. So, we would start you with the SPY first. Now, from this perspective, of course, while the market is uncertain, and let's face it, even more than 100 years ago when J.P. Morgan was asked, somebody said, hey, J.P., what's the market going to do today? And his prediction, he said, the market will fluctuate. He wasn't going to put himself on the line for basically having to make a call about which way the market was going to go. So, my thought is, we know that, we can get an edge with the market timing system, but there's still less than perfect certainty, right? So we have to manage that uncertainty on the price moves, the underlying. On the other side, though, the movement of time, you and I know, is consistent. 24 hours a day, 7 days a week. You know that the markets are open 9:30 to 4 p.m. Eastern time, Wall Street time. And so the bottom line is, how much time is going by there in the markets and day to day. And that time literally becomes money. And the whole approach here is to now cue the Rolling Stones song and say, look, let's put time on your side. If we put time on our side, we get the benefit of time marching on and literally that sands passing through that hourglass. This is called time decay in the options world. Put that decay in your favor by selling that time and essentially getting paid for that time going by. You also get to free up your time because, of course, we call it real-time trades for our subscribers, and we send out real-time email alerts when to get in, when to get out, and then I do weekly videos to train you as well, so you know exactly how I'm looking at the markets each and every day. Now, a quick little options lesson on the Greeks. One of the Greeks is theta. Theta, T for theta, T for time. That's how to remember that. Theta just means, how fast that time is burning by. That as you get closer and closer to expiration on this next chart here, you'll see that, if you're 120 days out and you say you just hold an option for a day, well, if you hold it 120 days to 119, you've lost less than 1% of your total time in that trade in calendar days. You can see that if you go down here and you're 1 day left before expiration, guess what? You hold it for a day, you just lost 100% of your options life in the last day as a 1 day holder. So the thought is, I'm not a day trader per se. In this strategy, we're going to hold it an average of about 6 days overall, so about a week or so. But the bottom line here is that you can see it, the chart is accelerating, getting more and more a rapid of a decay rate as you get closer and closer to the expiration date. Why is that? It's because of that percentage factor that's going by at a faster and faster rate. Every day matters more and more as you get closer and closer to the expiration. You can see, in fact, the 30 days shows you that you about something like maybe 2/3 of the total premium here is happening in the last 30 days. You say, why don't I sell a 30-day option? Well, I take that a little step further and say, you know what? If I look about 7 days out, that you can see here that about, in this case, somewhere around maybe a quarter to 30% of the option is going by in that last 7 days. So I can get the most time premium. You colored the area under the curve and just did this 7-day strategy the last week or so before expiration. With weekly options that now exist, I can actually benefit from that the most. Okay, and so we've got a couple of case studies too. We'll show you. So essentially, and with the Donchian channels, what we're looking at is the markets are going to, as J.P. Morgan said, fluctuate. We're looking to take advantage of that sort of what I would call the manic depressive state of most investors and traders these days. You know, about the time that the market is kind of tanking off here and hitting down to the lower band off a big down day, people are panicking, right? That's where you need to be getting ready for the markets to start getting ready to turn. Then the market bounces back, you see it pop up, and then you see that's where you actually want to be ready to bet the other way. So in this case, when it came down right in here, we actually said, okay, you know what? 10-12, after it came down at 10-11, we were watching our intraday filters to make sure we're not catching a falling knife. So we don't just use this daily chart. This is a starting point that I wanted to share with you today with my compliments, but as a subscriber, you get all the ins and outs of the intraday confirming turning points as well. Basically, we catch that turning point, and here's a good example where you want to have a little wiggle room. Because remember, we did the 211, 210 put credit spread. What that means is that if you sell a 211 put and buy a 210 put, we collect in that case about $20 a contract. We were risking $80 a contract, so our maximum gain here would have been about a 25% return over the course of the next week. As I said before, we are now getting out if we can get roughly 3/4 of our maximum profit. So if we can make 25% and say, you know what, in this market, if we can get 3/4 of that, that's an 18.75% gain. This is not a home run. This is much more, we're in the World Series now, this is much more of a putting runs on the board by putting men on base, by putting small, steady winners into your portfolio. As long as you control the strikeouts, as long as you control the risk, so that you don't get hurt too much when it doesn't work, you can score a lot of runs in your portfolio. You can really build your wealth. Notice, in this case, the market briefly went down a day or two after we got in, but it didn't even get down to this. This is the range here. This is 211 here on the upper yellow line. You can see it got close there on that short-term low point there, and then we flipped right back up that same day. Actually, by the end of the day, we were even back over about 212.5 to 213. So that support level in general that had been in place going all the way back on this chart to September 9th, 212.5 range was holding as well. So you can see we bounced back up. Now, of course, this was about a week ago as we came into the start of this week. We gapped up, actually, this was on Monday. And I told people, watch out below. The market is at some risk here where it could actually flip back down. What's interesting is if I update that chart for you here real quick, let's just take a quick peek at the SPY. Remember, the SPY trades a ton of volume. So if you look here at what SPY did at the start of the week, we were getting a sell signal set up here. You can see that was telling us, okay, into that pop up on Monday, this was a problem for the markets. And you saw the markets this week came right back down, and we were getting close to it, and look at what happened. It was actually suggesting that we get ready for a turning point back to the upside as we came into yesterday's trading here and looked at actually the close of yesterday's trading, saying, you know what, this is setting up for a buy signal. So coming into this week, whereas I told people on Monday, watch out, the market could correct, and it did. Now I'm telling you, guess what? We could get a bounce. Now, I wouldn't go load your portfolio into this, although guess what? I did share with you that seasonality effect as well. So, you know, it's not a bad time to consider that, but again, it's not a recommendation. It's just saying we're looking at the history of how this strategy has performed, and even while other people are saying this is like a death by 1,000 cuts market, you know what? It keeps on making money. Remember I showed you before it was up about 40K? It's up more. You know, gross profits here, updating that here in recent times. So you see that the performance graph of this, again, past performance doesn't guarantee future success, but you can see it's been steady as she goes to the upside here, especially in recent months. So, you know, and you can see when it gets on a good run, it can be very, very powerful how long those runs can last. These are over the course of a year plus in a number of examples. But the bottom line is that regardless, even when it flattens out, I'm pretty confident that we're going to be able to cash flow it with this credit spread strategy. These other tools I look at like %R, CCI, ADX, and DMI, these are tools that kind of confirm what we're seeing, but essentially the Donchians along with the short-term work is really going to be our driving factor here. Okay, so from this perspective, what we're looking at is, okay, you know, where to get in and more importantly, how to get out. So we'll take our profits early as appropriate to minimize our risk. Like I said before, a big part of this whole approach is that the SPY focus has made our life and will make your life a lot simpler. You don't have to look at hundreds or even thousands of different optionable stocks. You can just focus on the most liquid active vehicle out there. Now, I used to just do this strategy once a month back in the day before I had weekly options. Now, with an average holding time of 6 days, whereas I could usually just do this once a month back in the day. Now I can do this typically every single week. So you're going to get opportunities that are going to average about 4 to 5 trades a month. You know, we would say over the course of a year, expect about 52 trades, expect to trade a week as a good average, give or take. We use our technical analysis of our system that we've developed to adjust to market volatility. Guess what? The market gets more volatile after the election. Those bands, those Donchian channels in this case that I share with you, are going to actually dramatically widen as well. So you will adapt based on what the market is telling you it's in a tight or a wide trading range. Now, some of the key and simple strategy guidelines I want to share with you. Like I said, if you've got a holding period of about 6 calendar days, weekly options are typically added on a Thursday to expire the next Friday. Now, with SPY options, they keep adding even more contracts. They even now have Wednesday expiration options on SPY that were just added at the end of August. We're focused on the end of the week because that's where even more liquidity is, but you could do this countless different ways. In fact, with my trading room community yesterday, I was talking about how you might even position this coming week in front of the jobs day to do Friday with the SPY Wednesday weekly. So there's a lot of different ways you can trade. We teach people about that all the time here at Big Trends. But this strategy, we're focused just Friday to Friday and averaging about a trade a week. And we mentioned OTM is out of the money. That gives us that breathing room. If you get greedy with this strategy, that's where you go wrong. In fact, greed kills just about any good trading strategy. What I've found is that people that pyramid their profits, that would be the equivalent of like doubling down at the blackjack table after winning hand after winning hand. Eventually, if you keep doubling down, you're going to run into a bad hand and you're going to give back those hard-earned gains. So we really protect that capital by saying, let's just make sure we don't overcommit our capital on any one trade. And like I said, what's our return typically on a given trade? We're usually targeting around that 25% return on max risk as an ideal kind of a sweet spot. Sometimes we can get a little more, a little less. But think about it, if you're doing, say even on, if you use no more than 10% of your portfolio and you did a 25% gain for a week, that's about a 2.5% gain just on that contribution of that position to your overall portfolio. If you did your portfolio gaining at 2% plus a week, that annualizes at triple digits. You know, that's the kind of stuff that can get really powerful really quickly. So, you know, you don't have to hit home runs to have a well above average market returns. And so, like we said, on a half-point spread, we wouldn't risk about $40 per trade. A lot of times with what we're doing now with the SPY, we're using the full point strikes, which wouldn't be more than $80 risk per trade. Let's look at another case study from back earlier this month. Here's one where we actually did a put credit spread. So with a put credit spread, remember, now you're betting that the market is going to stabilize. You're betting that we're not going to go down very much. I'm sorry, this is the call. I take that back. This is the call credit spread. I should have changed that there. Call credit spread's the other way, though. Call credit spread's meaning that you're betting the market's not going to rally that much. You're selling a 217.5 call, betting that it's really not going to get through that 217.5 level. You buy the 218.5 call to protect yourself. So that's a 1-point credit spread. And you can see in this case, we were able to get a nice premium overall, got a nice fill on that one on October 3rd, and a few days later booked the majority of our profits as the market essentially just went flat. You see, it went in our favor the day after we got in with a big down red candle, then it bounced back. But, you know, with that time eroding and the market not going anywhere, that's where you're putting time on your side. So 22% gain in 3 days is a real healthy result. Sure, there's other times where you look back and say I could have made even more, but what we're doing is we're managing the risk for you so you can really make sure that you stay in the game for the long haul. I wanted to show you earlier in the year, from the time we tweaked this strategy back in mid-March, to get out early, is to say, you know what, when we said get out early, sometimes it still doesn't go for us. So you can see in this case, you started a $10,000 portfolio, you start building your wealth, and then you get dinged here. And you can see there are times where the losses are going to be a little bigger than your average gain because you're trying to give it a little bit of wiggle room where the markets can get volatile briefly, but we're watching them usually close to close, so we don't want to essentially get ourselves in a position where things get whippy, where we get whipsawed out of a trade. If there's one thing I hate about any kind of trading strategy, it's where you're right eventually. If you just had the patience to stay with it, and then you didn't have the patience, you bailed early, and you cost yourself a big opportunity. So with this example, you can see, yeah, we're going to give it that wiggle room, and that wiggle room told us, you know what, it's not working, we got to cut and run. So at about that 50% loss level, that's where we're saying, you know what, that's gonna be typically where we would say that's enough, let's move on. Now every once in a while it might get to a start working against this where we just see something we don't like and we get out 21%, 25% loss. So the point is that over the last 7 months, we don't just have one losing trade that I showed you before. We have the 4 losing trades total in 7 months. Obviously, a lot more winners, so we're still well over 80% winning rate for that entire 7-month period. So the beauty of this is that helps you to manage your capital and manage your risk, so that you're not all in. You're not going with that approach. I would always say, no matter how well this strategy is working, this shouldn't be the only strategy you use. It's my core strategy that I use to basically build my income base. See, a lot of people would say, hey, the market's so high, it's run up over, we've had a bull market, since the bottom in 2009. Here we are more than 7 years later. So we've had a 7-year plus bull market. Why do I want to buy the market here with the new president coming in? Who knows what they're going to do, et cetera? And I can say, you know what, that's a good point. Even though I happen to be bullish over the next 6 to 9 months, the point here would be that, regardless of what the market does, I want to be able to adapt to it. And for this money, I'm not committed to the market long term. You can basically be in and out in a week. Win or lose, you're back to the sidelines. And also, like I said, if you're putting in no more than 10% of your capital that you apply to this service to trade, so for example, if you put in 10K to start, as just an example only kind of a thought, say, you know what, in this case, I'm not putting in more than $1,000 a trade, so not more than 10% risk at any time. And we don't compound our profits here, so we're not trying to be greedy here. We're just trying to take this slow and steady way to wealth, and it's worked really nicely because from that perspective, as you update it, you keep on going forward, and you say, you know what, there's going to be losses along the way, but if we control that risk, keep following the system, 7-month return, 32.6% gross profit. That's $3,263 gross profit dollars. Even after you factor out commissions, you're still thousands ahead. The point of this is that from that perspective, you can really put yourself in a really good spot, and you don't care anymore about what the market's going to do a year from now, 3 years from now, 5 years from now. What you're really caring about is, how's the market setting up for the next week? This is where we look back at that chart I just showed you and say, you know what, a week ago, actually Monday's close, I was telling people, watch out below. Now I'm telling people, get ready for a bounce. The system suggests that the odds favor a bounce into the next week or so. So we're going to be looking for the right spot intraday to get a put credit spread on there. I'm not making a recommendation here. I'm just telling you where the odds are stacking in your favor. Some would say, well, that makes me, I'm not that perma bull or perma bear. I think it's unwise to get locked in to any one kind of view on the markets. I think that's going to get you in trouble. You want to stay flexible. One of the great opportunities that the markets give you is the ability to hop in and hop out whenever you see something along the way that you don't like. Now, Frank says, what's your best price? Okay, so one of the things I want to share, I want to answer some questions because I know I'm coming up on the end of my time here, so I want to share with you kind of the way we've got this structure for you here. Now, my best price is, if you just want to try 3 months, your lowest price, if you will, would usually be $299. I'm offering here as part of this 3-month or 3-month offer for the 3-year celebration and anniversary for Investors Inspiration for just $199. I'm taking $100 off of a 3-month rate for you. That'll get you about 12 trades over the next 3 months. That would definitely get you started. So if you're just looking to start small on a dollar basis, you can do that. And if you don't like it after a month, our normal pro-rata refund terms apply, so you can still get part of that back if it for some reason wasn't for you. But you know what? I set up something even better that takes all the risk off of you and puts it onto me to make sure that I continue to perform for you and all my fellow Index Options Timer subscribers, which is, I said, you know what? I'm going to give 100% money-back guarantee over the next 90 days worth of trades. Okay, so over the next 3 months, in celebration of the 3-year anniversary, over the next 3 months, it's not something I normally do for the masses here at Big Trends, but bottom line is that I said, you know what, try it for the next 3 months or 90 days. If I don't produce for you, then basically you're entitled to get all of your money back. All the entire year, which would normally be a $9.95 rate, I'm taking down to just $495 too. That gets your average on a per trade basis down under $10 a trade. So over the course of a yearly subscription, you get 50 plus trades, $495, phenomenal investment. More importantly, the full money back guarantee. Let me quickly show you how that's structured here, and then I'll hand it back over here for any other questions that we might have. Let me quickly pop up that page. I had it here, right here. Here it is. Let me share that with you now. So if you go to that page at bigtrends.com/index timer here, what you'll note, Chris Sarah, my lead consultant, has posted in here for you as well, is that when you go to that, you'll see the various ways you can get started. And you'll see everything you get. It's not just calling out trades. It's not a black box. I give you weekly video updates. I train you every single week along the way at what I'm looking for, what you should be looking for. And you can get 12 months for $4.95. I even added an extra special bonus second year for only a total all-in price of $7.95 with the money-back guarantee. Or if you want to click on the text below, click here to get 3 months of the index option timer, just $1.99. That has the pro rata terms of service guarantee on that. But if you want the full 90-day, 100% money-back guarantee, just click on that that orange button there to add it to your cart, and you'll actually see the guarantee in your shopping cart here. So you can actually click on that, and you can see it entitles you to a full 100% refund if after the first 90 days we have you operating at a loss on the portfolio. So basically, we're saying, look, we got to be on the plus side of the ledger so that you're making money on the trades overall. There's going to be losing trades. Do not overcommit after a winning streak. That's how you get yourself in trouble. You just want to be steady with this and apply the same money into each and every trade. You tend to have a really positive edge with this system. If you want to add the second year, you just say double my subscription time. You just click the yes, and it takes it from $4.95 to $7.95. That's a $2,000 value, $1,990 officially, down to $7.95. That's like 60% off. Or if you just want to try the year, that's half off for $4.95. You hit the green checkout button, and you can see it'll just pop up down below the fields you need to fill out. Review all that. Click on the terms of service box that are spelled out down here below. Read that, and then hit your green submit order button. You're good to go. So, with that in mind, basically, the question is, okay, so where's the market headed? I believe it's headed powerfully bullish over the next 6 months. But you know what? It doesn't matter. What matters is I'm going to be following the system for all of my index options timers here at Big Trends, and you can join to become one of those that exclusive group. We don't have a lot of these spots left, so I've just held this out for the next 20 spots because I know with the money back guarantee it gets a lot of people very excited to say, hey, I'm taking all the risk here as a CEO of Big Trends. Yes, to say, you know what, if I don't deliver after 90 days, you can say, I want all my money back. If you want it back sooner, you can use the normal pro rata refund and get most of it back that way too. So you know what? I'm on the line all the time, but bottom line is I have that kind of confidence in this system. We've been generating very consistent returns in any type of a market. So basically, the big thing is, as I said, risk management, so we make sure that trades don't get away from us, and the 2 out of 10 that we expect that won't work. If you've got a system that says, roughly 80% of the time you should be winning, you can place each new trade with a lot more confidence. So from that perspective, you can definitely benefit from that. Jim, a couple of quick questions, and I'll hand it back over. Jimmy said you can trade for us, right? You can actually do this yourself. There's a few brokers who will auto-trade this for you. My lead consultant, Chris Sarah, can get you more details on that. So you can actually reach him at that toll-free number in the bottom left, that 800-244-8736 number, or if you can't remember that later, just remember it's 800-BIG-TRENDS. That'll get you to us toll-free. Mary Beth says, how much capital do you need to take advantage of all the trades? I showed you what a typical model portfolio would be of around 10,000 with putting in about 10% per trade. You could do it with less, but my concern is that you start getting yourself in a position where you start taking on too much risk per trade. I want to make sure you're committed to stay with it through everybody can stay with it through the good trades. The question is, if you start off and we have a losing trade to start, I don't want you bailing. I want you to look at this as like, how can you just apply steady money, not trying to apply too much to any one trade, just apply steady, consistent capital. That's going to help you be a lot more effective. Let's see what other questions I missed. And then let's see. How long is this offer good for? Giselle says, like I said, for the first 20 spots, so we're going to make it good here into next week. So basically, through the end of next week, if you don't take advantage of it, then we'll shut it down. But bottom line is that you also might miss a trade if you're waiting. So we don't want you missing a trade. We want you taking advantage of this. And so, of course, I'm putting all the risk on me for that money-back guarantee period over the first 90-day evaluation period. See any other questions, and I'll hand it back over. Looks like that's actually handled a lot of them. I might have missed a couple earlier. Let me hand it back over to the good folks at Investors Inspiration and say congratulations again on your 3-year anniversary, and look forward to many more years of success for you all. And it's been a pleasure working with you.